if you look at it and you can see it in your chart here, actually what you kind of had was a tapering wedge. So clearly we're reaching a point where some kind of change had to occur.
Yeah.
But the actual catalyst for that breakout, I can give you some theories, and I'll do so now. But in reality, it's a little bit difficult to say precisely from a timing perspective. What we can say is, why did the price not react over the last 2 years? Well, clearly there was a balancing factor, and that was a drawdown from above ground stocks.
Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. Joining us today is Ed Sterck, Director in Research in the World Platinum Investment Council. Ed's a leading voice in the platinum market with years of experience analyzing supply, demand, and investment trends. If you want to know where platinum is headed next, you'll want to hear what he has to say. Ed, thank you for coming on the show.
Steve, thank you for inviting me on. I'm looking forward to our discussion.
I've been looking forward to this as well. Go ahead and, this is your first time on the show. Go ahead and start off by telling us your story, how you got into PGMs, and how that led to where you are today.
Yeah, thank you. So by training, I'm a geologist originally. I graduated just after a big sort of crash in commodity markets, the Bank of England selling its gold holdings and so on, and so job opportunities weren't that readily available in the mining industry. So I actually ended up trading interest rate derivatives for 5 years. 2 years for a US prop house, and then 3 years for myself, which went very well to begin with. And then I had a fairly bad fifth year, so time for a change of career. Moved into mining equity research and did that from 2006 through to until 2001, when I joined the World Platinum Investment Council. Now, part of my sort of mining research was I originally started with uranium, where it was the uranium equities, but I also did the supply-demand analysis for the commodity. Then I added PGMs, so hence my kind of experience in this space. Diamonds, also now a fairly niche area. Back then, quite a bit bigger in terms of the company market caps and so on. And then I ended up covering the European copper companies, and finally the large cap diversified, so the Rio Tintos, BHPs, and so on of the world. And since joining the World Platinum Investment Council, I've been running our research activities. As an organization, you can think of us as being very similar to the World Gold Council, in that we're funded by the mining companies, and our mandate is to develop the end markets, the end demand for, in our case, the PGMs and principally platinum. Now, we do that in two ways as an organization. So part of the organization is tasked with partnering with mints, refineries, bullion dealers, and so on around the world, and we help them design, produce, market, and sell platinum investment products. So that's bars and coins, and physical bars and coins, and principally to a retail investor audience. And then the other part of the organization, which is the side that I run, we think that the PGMs are not necessarily that well catered for in terms of sell-side commodity research. There are some very good commentators out there, but we think there's the space for some more in-depth analysis. And so we try to fill that gap. And we do this by producing sell-side type research. It's all available for free on our website, platinuminvestment.com. And then I go around the world and I talk to institutional investors, so hedge funds, pension funds, and so on. And the way I look at this is I'm just trying to increase information liquidity. We don't give price forecasts, so we're not going to tell you that platinum's going to double tomorrow or halve tomorrow. But we give people information so that they can make their own decisions more quickly and readily and move in and out of the space more quickly. So increasing information liquidity hopefully increases total liquidity and the pool of AUM that can invest in these metals. So that's the way we kind of look at that from a philosophical perspective.
Okay, so you started off as a geologist, entering in, I think, just a victim of time in the commodity cycle. Then you started trading and moved on to uranium supply demand dynamics. Then you joined up with the World Platinum Investment Council, and okay, I'm understanding this a little bit more. So mining companies basically pay you guys to do research so that they can correctly allocate where to go after PGMs or not. Is that?
It's more to develop end demand. So if you think about, actually a good example of this would be within China, there was really no investment in platinum in China in 2018, virtually 0 ounces. We've worked there to develop that market, and last year it was 250,000 ounces in terms of demand for principally platinum bars, but also coins. Given the total platinum market is only 8 million ounces a year, give or take, that's quite a significant impact on the end demand for these companies, these mining companies, commodities. And that's just China as an example. We've got partners in North America, Europe, Australasia, more broadly in Southeast Asia, and so on as well. And from an institutional investor perspective, we're thinking more about helping institutional investors make investment decisions around, should they be positioned in ETFs and how big should those positions be? And ETFs are obviously physically backed as well. So there's physical platinum that is going into those investment decisions. Total ETF holdings today for platinum around 3.1 million ounces. So a pretty considerable level of investment that's been brought to bear there.
Okay, that kind of segues into our next question on supply demand. So investment in China went from 0 to 250,000 ounces, and when the world demand is 8 million ounces, that's a big clip. And as far as ETFs, how much like PPLT and the Sprott Physical Platinum and Palladium Trust, those combined have 3.1 million ounces sitting in warehouses?
Correct, yeah.
Okay, all right. So that's almost half of the annual demand. Okay, if you got any charts or anything, that'd be great. If not, if you want to just talk through it, like what is your what are the current supply demand models right now showing for both platinum and palladium?
Okay, so I mean, just taking a step back and just giving a bit more information, because we are owned by the producers, we're quite tightly bound by antitrust legislation. So anything that could be considered to be influential from a near-term pricing perspective, such as supply and demand, is done for us on an independent third-party basis. So the numbers for 2025 and historically, those are the estimates provided by a group called Metals Focus. They do the same for the World Gold Council, the Silver Institute, and so on. So well-regarded international organization. But then we have our own forecasts for 2026 and beyond. So just to kind of reiterate, near-term estimates I'm speaking to will be Metals Focus's, so an independent third party, and then we have our own medium to longer term outlook. So starting with the current situation, this year we're forecasting a deficit of 966,000 ounces, so almost a 1 million ounce shortfall. And it's just worth highlighting that this comes on the back of consecutive deficits that were also close to 1 million ounces for 2023 and 2024. So we're in our third year of meaningful market shortfall. What's bringing this about? Well, fundamentally, mine supply has been extremely constrained. There's been a lot of challenges. We saw a big reset in terms of the palladium and rhodium prices over the course of 2023 predominantly. That significantly sort of impacted on the mining companies' profit margins. They did a lot of restructuring and as a consequence focused on the most profitable ounces. In terms of recycling supply, which makes up about sort of 25% of the supply picture overall, that again has also been quite heavily constrained. There's been an overall shortage of end-of-life vehicles, so effectively reprocessing spent catalytic converters from vehicles that are being scrapped. That makes up about 75% of the platinum recycling profile. The rest comes from jewelry and from predominantly scrap electronics. And that's been heavily impacted again by the prices of rhodium and palladium resetting through the course of 2023. So that's eroded the economic rationale for the scrap aggregators and the recyclers to process that material. So a very constrained supply picture. And then in terms of demand, I think over the last few years, we wouldn't necessarily say we've been in a strong growth market in terms of demand. It's been healthy and it's been probably more robust than a lot of people had anticipated. About 45% of platinum's end use is in catalytic converters. So those are only used on vehicles with internal combustion engines, which are also known as ICE vehicles. So whether they're pure ICE or whether they're hybrids. And I think if we think about the changing landscape of the automotive industry over the last 10 years or so, electrification, pure battery electrification has been a big feature of that. And so that's had quite a large bearing on the perception of future demand for PGMs. The catalytic converters contain a blend of platinum, palladium, and rhodium, which are three of the platinum group metals. And that I think has had quite a significant overlay on value establishment in the market and the perception of which direction the metal prices should probably move in. The other component of platinum's demand is jewelry. So jewelry makes out about 25% of demand. There, the story is quite nuanced, and we can get into all of these segments in more detail if you'd like to later. But broadly speaking, China used to be a 2 million ounce a year platinum jewelry market. And over the last 10 years, that shrank to 2023, a low point of 400,000 ounces. So a significant decline. We're seeing a bit of an inflection point in China at the moment, and actually potentially some really quite significant growth in jewelry demand this year. But broadly speaking, that decline in China has been to a degree offset by pretty consistent growth in demand for platinum jewelry in other geographies. So around a 3.5% CAGR in terms of demand growth for the world ex-China, mainly driven by Europe and North America. And we see that as something that could be quite attractive going forwards and potential further upside. Then you've got industrial demand. So that makes up about 30% of the total demand picture for platinum. It's kind of a catch-all there's so many different platinum applications, from petroleum refining to medical applications. There are cancer treatment drugs that are platinum based. Stents and things are often made with platinum. Then you've got the hydrogen economy, which is starting off a low base, but that falls into the industrial classification for us. And fiberglass manufacturing, believe it or not, fiberglass uses platinum in the production process, not in the product, but in the production process. And so things like the growth of wind power generating capacity, that consumes a lot of fiberglass. So overall, we've seen a really strong industrial market from all of these slightly diverse end segments. But that's something that is sort of plateauing a bit this year. We've had a lot of capacity additions. Those are tailing off. But overall, it remains at elevated levels. And then finally, completing the picture, we've had investment demand. And investment demand has overall been growing pretty strongly, bar and coin being driven largely by China. That has been offsetting to a degree some weakness in the US, which this year at least is somewhat linked to some of the tariff challenges. But overall, the trend has been for increased investment demand, and ETFs have played a part of that. We have seen quite significant ETF additions through the course of 2024. This year, we're seeing some profit taking naturally with the price increase we've seen over the last few weeks, but it still hasn't taken the heat out of the market. If we look at the kind of expected balances towards the end of this year, as I said, it's almost a 1 million ounce deficit. We're not seeing anything so far this year that's necessarily going to significantly reduce that deficit. So still very tight market conditions, and those are expected to persist for the foreseeable future.
Okay, so generally speaking, we have about an 8 million ounce demand this year, but we're only pulling out of the ground about 7 million ounces. So we have about a 1 million ounce deficit there.
Correct.
Okay. And as far as demand, about 45% goes to catalytic converters, 25% to jewelry, 30% to random industrial demands that get broken down to the nth degree. Are you counting the investment demand, the bullion bars and coins? Does that go under jewelry, or does that go under industrial?
No, that goes under its own category. So I've just kind of give you those percentages in terms of the market are kind of approximate based upon there's an ebb and flow in the balance of the market in any given year, depending upon immediate trends, for example.
Okay.
And it's worth noting, there have been years where, in effect, investment demand has been negative because we've seen more ETF disposals than we've seen purchases in terms of bar and coin. 2021 is an example of that sort of year.
Okay. I'm gonna share my screen here, and I'm a bit of a chartist. And here's the platinum chart. Okay, so platinum was just kind of boring for like ever, and then it finally broke out right here. What is your best guess on this? Would this be from from the China jewelry demand, or I mean, we're basically buying into this because of the deficit scenario that you've outlined over the last few years, and we've been reading your articles. Do you think it finally caught up with it? What's your opinion on this move on the chart?
I think, in a way, it's sort of taking a step back. One of the things that's been quite difficult has been explaining to the market why we've had, at the beginning of this year, 2 years of really meaningful deficits and no price action. In effect, the platinum price was range bound between approximately $900 an ounce and $1,100 an ounce. over the past 4 or 5 years. I mean, if you look at it and you can see it in your chart here, actually what you kind of had was a tapering wedge. So clearly we're reaching a point where that some kind of change had to occur.
Yeah.
But the actual catalyst for that breakout, I can give you some theories, and I'll do so now. But in reality, it's a little bit difficult to say precisely from a timing perspective. What we can say is, why did the price not react over the last 2 years? Well, clearly there was a balancing factor, and that was a drawdown from above ground stocks. Now, all commodity markets have above ground stocks. They're part of a healthy, functioning commodity market. The LME, for example, discloses copper warehouse inventory levels and so on. But the pace of the change in those above ground stocks, is probably key to providing the market some guidance as to how tight or loose market conditions are going to be. The challenge for platinum and for palladium is that those above ground stocks are not publicly disclosed. And so there's a lot of uncertainty in the level of those above ground stocks and the adequacy of them to continue to balance a market in deficit in the last few years' case. And I think that also the estimates of those above ground stocks vary quite significantly. So our categorization of above ground stocks is pretty simple. It's any unallocated vaulted material that's not in ETFs. It's not in exchange stocks. So those are the stocks put into NYMEX as an example to collateralize short positions. And it's not in working inventories held by the automakers or industrial end users. The problem is that a lot of other market commentators do include ETFs. They do include exchange stocks and working inventories. And so that kind of muddies the waters. And I think it gave the market a degree of overconfidence that actually platinum supplies were adequate until one day when they weren't. And that's why we've seen the price move at such a quick pace, from that moment of discovering that conditions were tight. Now, even so, taking a step back, actually, if you look at the other market indicators, so you can look at things like lease rates. So that's the cost of borrowing metal for short or medium term durations. And if you look at the shape of the forward curve as an indicator of I guess how tight or otherwise market conditions were, lease rates began to go up in December 2024. And you can time that quite clearly with when post-election but pre-inauguration, Trump began to talk more and more about tariffs, and the market began to understand that tariffs were going to be a really significant part of this second presidency. So lease rates began to go up, but you also saw US end users trying to onshore metal in order to protect themselves against the risk of metal they might own in London already being suddenly subject to a 20% tariff charge or whatever. So bring it into the US, protect yourself. And that created a shortage of metal in the London market. So we saw London go into a deep backwardation, classic indicator of a market that's in extremely tight conditions. And those conditions just persisted throughout, all the way through from December 2024 until May, until suddenly things began to move. It coincided with London Platinum Week, and there are 3 Platinum Weeks around the world: London, Shanghai, and New York in order. And I think really there was just some discovery during London Platinum Week. People suddenly woke up, not the kind of day-to-day participants in the market, but the broader investment community woke up to the high lease rates, the backwardation, etc., pointing to tight market conditions, the tariff challenges. And then suddenly we got news that actually it looked like there was an inflection point in demand in China for platinum jewelry. People began to pay more attention to the pace of physical investment demand for platinum in China, and these things in aggregate just seem to get the market moving effectively. And since then, obviously, it sort of changed positioning quite rapidly.
Okay. So it was kind of always there. There's this opaque above ground supply. So you, like everyone else, doesn't have a secret red phone line to Russia to ask them how much they have or how much they're selling into the market. You have to guess like everyone else. But a clue that you noticed was lease rates going into these things. And when those started to spike, that's, futures traders are probably some of the smartest people on the planet. And when they, when you see these lease rates go up, that could be like a little flag waving, letting you know that like, hey, something's happening here. And then on top of that, you'd guess that with the London and the Shanghai and the New York conferences that went on. That just brought about a general awareness, which probably led to a little bit of a price hike.
Yeah, I think so. I mean, the New York Platinum Week actually hasn't happened yet. It's in a few weeks' time. So maybe there'll be more, information to find out around that. But yeah, certainly it's just, there was this competition from, I think what we've seen is really a stronger than expected two-way competition for metal with a geographic divergence. So metal going into the US and metal going into China. And if you look at, I mentioned that the London market went into strong backwardation, which it's still in today. The US market didn't. It remained steeply in contango. And that's what ultimately, I think, was part of the driving force behind higher lease rates as well. And that contango reflected the fact that US end users were happy to pay a premium for platinum delivery in 3 or 6 months' time, whatever the time frame was, because that premium was still less than their interpretation of what tariffs would be.
Yeah.
And so you can see that then drove, and I'm not sure how sort of technical you want to get into things here, but that then drove a time value arbitrage opportunity for
Yes.
speculators on the New York, on NYMEX and the New York Mercantile Exchange to go short the futures and long the prompt market and capture that value disconnect over time. But to go short the futures, they had to collateralize those positions. And so we saw significant flows of metal into CME approved warehouses in order to back those positions.
Very interesting. And they took physical deliveries of do the bars that they have to deliver, did it have to go to a smelter and get, put down to a different size before it was shipped? Was there any backup there or?
Yeah, so NYMEX good delivery bars have to fit certain criteria. So broadly speaking, 50-ounce bars. That's not necessarily the form of metal that end users would prefer to receive. Most industrial and automotive end users want what's known as platinum sponge. So it's kind of like powdered platinum, basically. So those bars, if they were being bought by automotive or industrial users, would have to be converted after taking delivery of them. But
Okay.
that's not it's not there's a cost to it, but it's certainly there's industrial capacity to make that, those conversions.
Okay. Interesting. Let me share my screen again here, and I would be remiss if I did not bring this up. Okay, platinum divided by gold. So I'm sure you're familiar with this chart. What maybe macro thoughts here? Right now, we're not even at 50% platinum divided by silver. We're essentially a little bit more than a kilo of silver will get you 1 ounce of platinum. Maybe just pontificate on these ratio charts here for a moment.
Yeah, so I mean, to be honest with you, I don't really have probably much to say on silver, but we've always looked at platinum versus gold as being, I think, probably the ratio that tends to get the most attention. And probably similarly for silver to gold rather than necessarily to platinum. But I think in a way, if you look at the platinum to gold ratio, platinum is on average traded at twice the price of gold since 1880. Now, part of that is probably a function of the kind of pricing impact that the gold standard had in the past and so on. But still, nonetheless, clearly right now, we're in a very different situation where platinum's trading at about sort of 40% of the price of gold or less. Why is that? I mean, I think that this has kind of come about over the last few years. I would argue that gold is, to a degree, the outlier here. It's been treading its own path. We've just seen this big trend towards hard asset ownership over the last few years in different geographies around the world. Lots of central bank buying, to a degree, a de-dollarization trade, particularly over the last 3 years. And so I think the alternatives are just there aren't that many alternatives. Some people would argue Bitcoin is an alternative. I'm not necessarily totally convinced on that, but enough people have been to see the price of Bitcoin transform quite dramatically, obviously. But I think your typical go-to alternative is going to be gold. And right now, especially with sort of the geopolitical environment that we're looking at, I can't really see a reason for that necessarily to change. How does that influence platinum? Well, ratios are one thing to look at, but I think realistically, let's boil it down to platinum end demand. And certainly some of the demand growth we're seeing for platinum investment products is related to gold. So people are looking for lower cost alternatives, probably not because they're worried the gold price is too high, but more just what's your price direction risk? And certainly, through the early part of this year, I think the perception was that the perception risk was more to the upside for platinum, and gold was harder to call. And then the other thing, of course, is jewelry. So we mentioned that we're seeing this inflection point in the Chinese gold jewelry market. That is something that is very much being led by, to a degree initially, the fabricators and retailers. Gold jewelry sales fell 32% year on year in China. And the retailers and fabricators are trying to compensate for that and attract customers back with alternative product offerings. Silver doesn't really work in China, so you're really talking about platinum. And so that's resulted in a fairly significant increase in platinum fabrication. I'll just be a little cautious that we don't have the data yet to show that's truly translated into consumer end buying, but certainly there's been some pretty significant fabrication of platinum jewelry. And I kind of take a fairly simplistic view that people tend to buy from the selection that's put in front of them and not necessarily go out and hunt for specific things unless they're super keen on one particular idea. So I think it's encouraging, and after that multi-year decline in jewelry demand in China, we would certainly expect to see a fairly decent increase in demand this year going forwards. The other area is actually stepping outside China. In Europe and North America, and to a certain extent Japan, these are the markets that actually have quite a big white gold component to the gold jewelry market. White gold was originally developed as an alloy to be a low-cost alternative to platinum, but the gold price has moved so far now that at the retail level, based upon our market analysis and looking at actual price points at different retailers, we're seeing white gold goods being priced at a premium to platinum. And most consumers still think platinum is the premium, more desirable metal of the two. And if you can buy it at less than white gold, you're probably going to make that decision. White gold's 75% pure. Platinum jewelry is typically 9995 or 950.
Okay, wait. So what's the makeup of white gold?
So it depends on the exact alloy, but generally it's about 75% gold. Then you've got a fairly large base metal contingent. Quite often, actually, there is a bit of PGMs in there, so maybe some palladium or platinum, and then it's actually usually plated with rhodium, and that's because it's quite hard to get that real whiteness with that much gold content still in there. And plating it with rhodium means that you get that white metal experience. It doesn't tarnish like silver. It's just the same as platinum doesn't. And so it retains that whiteness for a certain period of time. The problem with that rhodium plating though, coating is we're talking about microns thick. It does wear away eventually. And so white gold quite often goes yellow with age.
Okay, interesting. I've heard white gold, but I never knew what the makeup was or any of that. Okay, so this ratio chart you're saying is really skewed here more because gold has kind of been in a unique macro environment where central banks across the planet are just buying it up like hotcakes. And so it's not so much that platinum is really, really cheap, it's that gold has gotten expensive, driving the chart down. Does that kind of summarize it?
Yeah, I think that's broadly. I mean, I would also say that platinum has had some headwinds. So that perception of the ongoing electrification of the global drivetrain meant we're all going to be driving Teslas by 2030. Slightly flippantly, but that's what a lot of people were expecting, was also probably holding platinum back. Very clearly, what we're seeing now in the automotive industry, which we've been forecasting for quite some time, is the pace of electrification is slowing. We're still going to see ongoing electrification of the drivetrain, no doubt about it, but it's just not going to happen as quickly as people had been anticipating. We're seeing the automakers now have to pivot, prioritize ICE vehicles, mainly hybrid vehicles, because they still need to try and reduce their fleet-wide CO2 reduction emissions. But that just means higher for longer automotive demand for PGMs. So it's supportive of a kind of improved demand outlook for those metals.
Okay, moving on here to palladium. Now, you guys are the World Platinum Investment Council, but you also study palladium as well, right?
Correct, yeah. So we run our palladium supply demand model that runs out 5 years as well, just the same as for platinum.
Okay, maybe run through macro view on palladium as well with what supply demand models you got.
Yeah, so look, with palladium, it's palladium has got compared to platinum. I mean, well, firstly, actually taking a step back, let's start with supply. So palladium supply and platinum supply are joined at the hip. There are no palladium or platinum mines in the world. They're really PGM mines, so platinum group metals. And all of these 6 platinum group metals come from the same deposits. And as a consequence, you can't kind of ramp up palladium supply because palladium has suddenly got really expensive. Because you've also got to take into account you're producing platinum, rhodium, ruthenium, iridium, osmium, copper, gold, nickel, and so on. And so it's the basket of value of all of those commodities that determines your ultimate mine supply output. So yeah, with that in mind, palladium prices were ran up to sort of record levels really in around 2020, starting from 2016. Palladium went to $3,000 an ounce, thereabouts. We've seen that was a function of the fact that there was fundamentally a shortage of palladium supply versus demand. We saw no response at all from the mining companies. In fact, actually, if you look over that high price period, and rhodium, I should say, went to $26,000 an ounce or something like that. Despite those high prices, mine supply actually contracted. So I'm just flagging that now as kind of something to think about with regards to the fact that for platinum, we've got these ongoing deficits, not just for the last 3 years, but on our 5-year outlook, those deficits persist for the foreseeable future. I don't think we're going to see mine supply particularly respond to that outlook, because for palladium, one of the challenges is, while supply is very constrained for palladium, just in the same way as it is for platinum, we are seeing challenges from a demand, greater challenges from a demand perspective. So more than 80% of palladium goes into catalytic converters. So it's much more heavily exposed than platinum to that electrification story. You can, to a degree, substitute platinum for palladium in catalytic converters, so you can adjust the relative quantities of those metals that you use in an exhaust treatment system. The last 5 years or so, we've seen the big trend where platinum has been substituted for palladium, so increasing platinum demand on a relative basis, slightly reducing palladium. We think that process is probably going to reverse slowly. It takes a long time over the next few years, which is favorable, relatively more favorable for palladium than for platinum. But fundamentally, palladium's greater exposure to the automotive industry just means that the demand outlook is not as attractive as it is for platinum. The biggest challenge for palladium, though, is recycling supply. So we've got a very constrained recycling supply market at the moment. But going forwards, our current base case forecast is for an increase in that recycling supply, particularly for palladium, and that in aggregate, those supply demand dynamics tip palladium towards a surplus. So whereas we've got platinum in a deficit for the foreseeable future, it's hard to give you precise timing on this, but sometime in 2026 or 2027, palladium goes from a deficit market to one that's in surplus. And that then doesn't really change within our current forecast time horizon. I would say, though, just to kind of risk assess that recycling supply forecast of growth, it's very contingent upon the palladium price. Palladium is the biggest driver of recycling price elasticity in terms of output. And because it's also going to have the biggest impact on the palladium market versus platinum, that kind of balance between increasing recycling supply, then suppressing prices, which then may hold back recycling supply and say prices go up again. That's going to be quite a difficult outlook to forecast in terms of the balance between that recycling supply and the economics to incentivize that supply.
Okay, so platinum and palladium are kind of joined at the hip. You're not going to find a platinum mine that doesn't also have palladium and vice versa, right? Apparently there's 6 deposits across the planet where we pull all this stuff out of the ground. As far as palladium and the supply-demand dynamics, there's right now we're seeing a deficit in platinum, but in palladium there's actually a surplus. So as far as the investment theme, at least there's
a coming surplus. This year we're still in a deficit, but in the future.
Okay. 2026, 2027, you expect there to be a surplus, but so far we've been in a deficit. And when you said catalytic converters, you said 80% of catalytic converters, or 80% of it is made up of palladium, not platinum. Is that what you said?
No, 80% of palladium's demand is going into catalytic converters.
Okay. 80% of palladium's demand is going into catalytic converters. Okay. And about what's the makeup of platinum and palladium in a catalytic converter on average?
Oh, that's a good question. So, I mean, in terms of the amount of PGMs in a catalytic converter in total, which is what we call the loadings. It really depends upon where you are in the world, the size of the engine, and the type of fuel that you're using. So diesel vehicles, obviously predominantly heavy duty, long distance, etc., they tend to be using they tend to use platinum more than palladium, and a decent amount of rhodium in there as well. And then when you look at the gasoline vehicles, those tend to be heavier in terms of the palladium content. As I said earlier, we have seen a trend for using more platinum and less palladium. That reflects the fact that through that period, 2019 to 2020, end of 2022, palladium was trading at a significant premium to platinum. So we're seeing that that resulted in demand to use the lower cost option, which was platinum at the time. Now we think that's probably going to shift a little bit, where going forwards there'll probably be a slightly greater preference for palladium over platinum, and so that kind of substitution process will trend the other way. I would say though, again, kind of risk assessing that view. If you look at the balance of production of these metals around the world, 70% of platinum comes from South Africa. If you add in Zimbabwe, then you're getting up towards 80%. In terms of, and 11% comes from Russia. If you look at palladium, it's more like 40% from Russia, 40% from South Africa, and maybe another 8% or so from Zimbabwe. So from an automaker perspective, choosing to go with a higher palladium mix in your catalytic converter naturally increases your exposure to Russian supply chain risks. So even if the economics might tell you to do that, from a security of supply perspective and supply chain risk management, you might just choose to continue to favor platinum.
Interesting. Okay, so for platinum, 70% comes from South Africa, 10% from Zimbabwe, 11% from Russia, and the other 9 comes from like everywhere else, probably the US and Canada, and who knows.
Yeah.
And then for palladium, 40% from Russia, 40% from South Africa, 8 from Zimbabwe, and the other 12% or whatever that is. Math and public isn't fun. Yeah, comes okay, US and Canada. Interesting. Okay. All right, we got some listener questions here. Deeps wants to know, he says, if nuclear plants are going to get more popular, will they create enough palladium to manipulate the price? And what maybe go into the nuances of that.
Yeah, so I mean, I haven't. This is something I've not looked at since back in my uranium days. So my recollections may be a little bit patchy in places, but broadly speaking, the kind of latest generation of nuclear reactors, if you're burning reprocessed spent nuclear fuel, so that's fuel where it's come out of an old reactor. The daughter products of your basic uranium decay include plutonium. You extract that plutonium, mix it with uranium-238, so the less fissile of the two uranium isotopes. You can then burn that fuel again in only the latest reactor designs, and one of the daughter products of that kind of decay path are the PGMs, including palladium, but not just palladium. You also get iridium and platinum and rhodium and so on. So and potentially it's quite a lot of PGMs, if I recall correctly, and this is where I definitely would have to go back and check myself. But we're talking tens to kind of 100 kilograms per ton of spent nuclear fuel. So, quite a lot. The problem is in delivering this is you've got to have the ability to reprocess spent nuclear fuel in the first place to separate out the plutonium. It's only really done in the UK and France, and to be honest, not particularly well in the UK. They're good at extracting the stuff and not that good at putting it back into repro fuel. But then you've also got the problem of once you burn that fuel again, it is highly, highly radioactive. Now, it's highly radioactive because it's got a really short half-life, so it does decay pretty quickly. But we're still talking, arguably decades for it to reach a safe level where you could then reprocess it and extract the metals that are contained within that. And you've then got to have that technology in place as well. So long answer to the short one, which is it's theoretically possible, and increasing nuclear power will definitely make it more economically feasible to put in place that additional infrastructure. But I wouldn't build it into your supply demand forecast just yet.
Okay, not investable in this in this cycle, possibly our lifetime. All right, good. I learned something new there. Okay, James wants to know. This is interesting. Okay, probable sources of new supply over the next 5 years and the extent to which these new sources will alleviate the current forecasted deficit.
So I think it's a good question from a geological perspective. Yeah, the PGMs are not well distributed globally. They're not evenly distributed globally. They're concentrated in only a few deposits, as you said earlier, Steve. Geologically, you've got the Bushveld in South Africa, which is effectively there's lots of mines there, but it's one massive ore body. You've got the Great Dyke in Zimbabwe. Similarly, it's one massive ore body with a few mines in it. You've then got Nornickel's assets in Russia, again very concentrated in terms of geographic area. Quite a few mines there, but effectively all operating from a few different but associated ore bodies. Then you've got the Sudbury area in Canada and then the Beartooth Mountains in Montana as being the current production centers to all intents and purposes. So, realistically, new supply is most likely to come from those same geographies because you've got the supporting infrastructure in place. Processing PGM-bearing ores and extracting the metals is a very complicated process where you go through concentrating activities to concentrate the ore. Then you go through a pyrometallurgical process, so smelting, and then that kind of gradually trends towards a hydrometallurgical process in terms of processing. So lots of complicated, large capital or expensive capital infrastructure. So I think that unless we see a real change in the processing technology, which is actually quite possible and people are working on it, we won't see new production centers easily emerge. So you're looking at production coming from the same places. I think and I mean, that said, there are some interesting exploration plays in other areas, and if they can come up with their own complete solution, there's certainly possible that we would see mines being developed. But I think at scale, it's likely to still be those historical production areas. So then we come down to what incentivizes mining companies to make new production decisions, and ultimately, it's the current economics based upon current and to a degree historical commodity prices, your production cost expectations in terms of capex and then opex, and then finally your kind of longer term outlook for those commodities. And the challenge I think for the mining companies is you're making go ahead decisions where you're going to be spending billions of dollars of shareholders' capital. Your return time frame is long because these are typically deep level underground mines, so it just takes time to develop, plus your permitting time frame and so on. And I think we can be pretty confident that the outlook for platinum is going to be one that's relatively attractive. Yes, you've got a kind of declining profile ultimately in terms of internal combustion engine demand through catalytic converters for PGMs. As I said, I think that story is going to take a lot longer to play out than people had anticipated, but you've got to match that up with a really long development timeframe for a mine. And you've got platinum's new end sources of demand, one of which is the hydrogen economy. It's coming much more slowly than people had hoped, but it's still coming. There's things like platinum catalysts for PVC production. At the moment, they use mercury-based catalyst that's being banned from 2030. It's a platinum gold catalyst actually, is the alternative, and that could be quite a significant demand driver. There are other areas that we can get into with platinum, but when you come to those projects, coming back to the fact that you're mining all the PGMs at once, so your value proposition is based upon all of those metals. And for palladium, more than 80% of its end use is in catalytic converters. For rhodium, similarly, more than 80% of it goes into catalytic converters. You've got to have a high degree of confidence as a board member that the end markets for those commodities will be there in the future. And I think that's quite difficult. We will see substitution within the PGM space. So probably some platinum will be substituted out for palladium and rhodium in different applications. But it's a really complicated equation for a board member to solve when they're saying, yep, we're going to spend X numbers of hundreds of millions of dollars over the next few years. So I don't envy them, but it's I think it's unlikely we're going to see any kind of mega transformation in PGM mine supply.
Okay, so of the big deposits, we got Bushfields, Great Dyke, Nornickel, Sudbury, and in the U.S. we have Montana. But it doesn't sound like you really see any big supply coming online in the near future.
I mean, there are some smaller operations, but again, we kind of come back to this problem where you could have a big deficit in platinum. We've seen it in other commodities where it's triggered a supply response. Not saying it couldn't happen because actually most of the mines in South Africa, for example, were originally built as platinum mines, but the value proposition has changed where the other PGMs are really important to the economics now. So we could return to that sort of scenario again, but based upon how the world is right now, it's difficult to I think to make that sort of investment decision.
Okay. Okay. All right. Um, on to let's see.
I mean, sorry, Steve, just to say one more thing on that.
Hmm.
There are clearly exploration and development opportunities, which could certainly make sense, but you've got to match that off against mine decline from big established operations where, we are seeing them slowly trend towards the end of their reserve lives. So, whilst new production could come on, it's probably just going to be displacing or replacing depleted production from elsewhere.
Okay. Okay. But I gotta believe, well, like when we pulled up the chart and palladium went up to 3,000 an ounce, um, I gotta believe if platinum and palladium get up around that level again, the miners in South Africa will just go deeper, right, with their mines, or
Yeah, I mean, quite conceivably, if we get back to those sorts of levels, then that's a very different picture,
yeah.
for sure. Yeah.
Okay. Okay. All right. Let's see. We hit Alvarez's question on recycling, market outlook, and macroeconomic factors. Okay. Gary wants to know. He says, what if there is a sustained 6 month to a year worldwide recession with deflation and lower interest rates? What does Ed think that will do to platinum prices?
Well, we don't give price forecasts, but I would say under that scenario, I'm not quite sure which investments are necessarily going to do well overall. So, yeah, I mean, I think, yeah, that would be a sort of fairly big negative from a demand perspective. Yeah, people are going to try to preserve capital, not buy large ticket items like new vehicles in the same volumes that they would have normally, and so it wouldn't be good for the demand profile of these metals.
Okay.
I think,
And,
you've got to counterbalance that with maybe we'd see that translate into a bit more investment demand as people are looking for capital preservation assets. But yeah, it's overall it'd be a challenging scenario, I think.
yeah, yeah. Gary, if you care, I would buy the dip. Chris, he wants to know, he's basically asking, do you see platinum as well, he's asking for all PGM, so we'll say platinum and palladium. Do you see them as precious metals or do you see them as industrial metals? Or he says half the experts rate them as a precious metal and the other half say they're only an industrial. What's your opinion?
Oh, look, I mean, undoubtedly they've got attributes of both. So, at the risk of sounding like I'm sitting on the fence, if you look, the way I kind of think about them is that they're a bit more similar to silver, where you've got your precious metal aspect to them, but also quite significant industrial end uses. And so that I think if you contrast them with gold, they're a bit more pro-cyclical, but they also retain some of the precious metal value preservation attributes that gold offers as well.
Okay, we hit Blake's question on the ratio with gold. And let's see. Okay, as far we got a lot of company specific questions. Maybe we got to go ahead and give us your spiel on company specific questions.
Yeah, so I mean, we can't really opine upon or give recommendations on specific companies or stocks. So it's just the function of the kind of organization we are. We're not regulated, and a lot of these guys are funding members. So we think it would be impolitic to be considered to be seen to opine upon their relative merits and ability to execute on their mine plans and so on.
They're funding you, so it'd be a
Yes.
conflict of interest.
Yeah.
Okay, um, let's round it out here. Where is Ed putting his money? Do you see the most value in platinum? Do you see the most value in palladium? What are your thoughts on that?
I mean, it's a good question. I mean, it comes a bit close to being a recommendation at that point, doesn't it? But I think if you look at the relative supply demand outlooks for the two metals, and again, kind of reiterating, we've got platinum in a deficit for the foreseeable future. So our forecast currently runs out to 2029. For palladium, trending towards a surplus. I think just the underlying fundamentals for platinum at this point in time appear to be more attractive than for palladiums. What could change that? I think for platinum, the landscape is relatively well mapped out. I think for palladium, realistically, there are two things that could change, both one of which would benefit platinum as well, which is, we could see a real pivot away from battery electrification on a global basis. Clearly some of the regulations that are being put through in the US are, I think, changing the landscape in that direction in the United States. The rest of the world seems committed still to decarbonisation, and certainly, I guess more efficient internal combustion engines, more hybrid vehicles, and more battery electric vehicles all fit into that narrative. And so, it would require a wholesale change on a more global basis. But, it could happen. The other thing would be, potentially a new source of palladium demand that we haven't identified yet, or at least, haven't the confidence in that it's going to be commercialized to make that transformation. One example of that would be there are some battery technologies that use palladium to increase energy density.
Oh,
That would obviously fit into the battery electrification story. That development I think is quite far advanced, but they haven't proven it at a commercial basis yet. So, but if that happens, then that could change things for palladium pretty significantly overnight.
okay. Yeah. So it sounds like you're saying that if your models are correct, then platinum should be in more of a deficit than palladium, and so that kind of answers that one. But we'll call it a black swan. The black swan is if the world starts to pivot away from this battery EV narrative, then there's going to be a radical reinvestment in palladium.
Yeah.
Okay. Okay. Ed, anything I should have asked that I didn't? Do you have any closing thoughts?
I thank you very much. No, I think the PGMs are an interesting space because the diversity of end uses, the exposure to different parts of the economy, that kind of quasi precious, quasi industrial sort of overlay on them. There's a lot of information. There's a lot of stuff to try and take on board, which can make it quite complicated. But fundamentally, I think at the most basic level, platinum we've got it in a deficit, and I can't really see that necessarily changing.
Okay. All right. We'll buy more platinum. Ed, thank you for coming back on the show. For coming on the show. If viewers want to get a hold of you and follow your work, how can they do so?
So look, you can contact us via our website, platinuminvestment.com. You can also reach us on LinkedIn as well. So we've got our corporate LinkedIn page, and then there's our personal ones too.
Awesome. We will put the links down below. Ed, thank you very much. This has been a real pleasure.
Super, Steve. Thanks for having me on.
Yes, and thank you for tuning in. Go to stevebartonmoney.com for more, and have a wonderful day.